If you are a founder of a direct-to-consumer brand looking to understand what sort of fundraising options you have in front of you, then this video is for you. Hi, my name is Anya. Welcome back to the channel. I'm a founder of an online community called Venture Muse Club, and it is a space for direct-to-consumer founders to connect with each other and learn from each other about how to learn their brands. And also on this channel, I share weekly content on how to grow D2C brands through content, community, as well as demystifying venture capital. So in this video, I'm going to talk about some common early stage funding options, revenue-based financing, as well as debt-based financing, so that you can get a general overview of what funding options are available to you as a brand. So let's jump straight into going over the common funding options for brands. And first one I want to talk about is friends and family. So friends and family round is fairly self-explanatory, but this is the most common way for most brands to start, where to kickstart the brand, the founder will either use their own savings account or go to their friends and family and raise a little bit of money. So friends and family round is a fairly uncomplicated concept. So I'm going to move on to the next one, which is crowdfunding. Now, crowdfunding is another very common early stage funding options for brands. And what makes crowdfunding very interesting is that you can use it actually both as a way to raise some capital for your brand, as well as get the community of early adoptive customers. So platforms like Kickstarter and Indiegogo, for example, are very great places for you as a brand, not only to raise some initial capital, but also to find those early adopters of your brand who will become your brand ambassadors and spread the word of mouth about you. Just be prepared that the amount of money that you're gonna raise through crowdfunding is only really gonna be enough to kickstart your brand in the beginning. However, if you do want to scale your brand further fairly quickly, you will need to look into other fundraising options further down the line. So next, let me talk about angel investors. And this is another very common funding options for early stage brands, especially when you are at the stage where you're not quite ready for venture capital yet, but you want to scale your brand quickly. The key to success when raising through angel investors is to really do your research and only approach investors who you know are passionate about your industry, because for a lot of angels, they look to back the brands that they really believe in and they're really passionate about. So do your research and see what sort of angels are specializing in the industry where your brand is at. A great way to find a potential angel investor is to start online, and you can set up a profile for your brand on platforms like Gus.com or Angelist.com and let it be known in the world that you are an early stage brand looking for a potential angel investor, as well as really invest time into building up your personal brand as a founder on platforms like LinkedIn. You really want to make sure that you as a founder and your brand are searchable online, and that if anyone were to come across you and were to do a quick search with your brand name or your name, there is some information that pops up. And don't discount the impact that offline events can have on finding a potential partner for your brand. So participate in local industry events, local exhibitions. If you are especially a fashion brand or your beauty brand, this can really help for you to find those potential growth partners. And so moving on from angel investors, I want to talk about venture capital. A quick side note that not every consumer brand is going to need venture capital to grow their brand. So it is not necessarily a requirement for your brand to raise money eventually from venture capital fund. Lots of companies out there bootstrap their way all the way to success and are very happy about it. But if you do look to expand into new geographical regions or maybe accelerate the growth of your brand, then finding the right venture capital partner is going to be a great decision for your brand. A few things to keep in mind when looking at raising from venture capital funds is try your best to find an investor who can provide you with what is called smart money. And that means that not just writing a check and then checking in with you once a quarter, but it means really becoming that strategic partner for your brand, having ability to make introductions and to give you advice for you as a founder for the questions that you're gonna face as your brand starts to grow and scale. A great way to verify whether or not the venture capital fund is going to become that smart money strategic partner for your brand is to look at their portfolio companies and seeing what is the growth trajectory, what is the growth sort of pattern for those brands, and then reaching out to the founders of those brands on platforms again like LinkedIn in and then checking in what was their experience working with that investor. So next, I wanted to touch on revenue-based financing. So if you are a consumer brand that already has a track record of bringing in a certain amount of revenue fairly consistently over a number of months, and if you are on a platform, for example, like Shopify, then revenue-based financing could be a great option for you. The way it typically works is platforms like Shopify will look at the brands on their platform and look for the companies that have a consistent track record of bringing in revenue, and then they will give you an advance loan, let's say of up to $1 million, I believe it's on Shopify last time I checked. And the structure of the repayment is that they will shave off a percentage of your revenue every single month. So revenue-based financing option is a great way for founders to raise money without over diluting themselves or actually selling any percentage ownership in the company. And while we're talking about non-diluting funding options for your brand, debt financing is another option available for you. And while debt financing might be tricky, especially for early stage brands, because more traditional institutions like banks would be very hesitant to lending money to an early stage company, it is a great way for a founder to get some cash, get some capital without diluting themselves. So debt might not necessarily be the best option for most entrepreneurs. However, it is very important to be aware of it, just to know what sort of options are available to you. And one of the things that I wanted to talk about here is business credit cards. And I think that this is sometimes overlooked by the founders, but if you do need that quick bridge of payments, for example, if your wholesale or retail partner hasn't paid you yet, but you have to pay your manufacturer, or you have to sort of bridge some of the bills that you are facing, a business credit card could be a great way for you to do that. And for example, an average business credit card in the US gives you somewhere about $56,000 worth of credit. So if you do need to bridge those quick little payments, having a business credit card open is a great way to do that. Of course, be very wary of the interest payments and do your absolute best to close those outstanding balances off every single month. So in this stage of the video, I have told you about some of the more common early stage fundraising options for direct-to-consumer brands. If you have any more questions, please feel free to leave a comment in the comment section. If you found this video useful, please like and subscribe, and I'll see you in the next video.